Welcome back to the Deep Dive. If you've been anywhere near the charts this week, you definitely know why we're here.
Oh, yeah?
We are diving into the immediate aftermath of, well, what analysts are already calling the single biggest market event of the year.
No exaggeration there.
We've got some incredibly timely data looking right at the crypto space just after this massive shock hit.
That's absolutely right. And this isn't just, market noise. The analysis we're looking at is pretty clear. We saw just a colossal sudden liquidation event.
Right.
And that got paired with a heavy dose of fresh uncertainty around macro policy. When those two things hit at once.
Yeah, you get chaos.
So our mission today feels pretty critical. We need to get past just the headline price drop.
Definitely.
We're going to unpack the immediate damage, figure out the exact drivers behind this correction, and maybe most importantly, try to separate that short-term fear from the underlying long-term structural stuff that's still moving forward. Yeah, it's a really necessary deep dive. What jumps out right away is how you had these volatile market mechanics, like the liquidations, crashing headfirst into institutional caution, all at the same time.
Okay.
We have to look past the immediate panic to see where the market's actually trying to go.
All right, let's start unpacking this.
Yeah.
Beginning with that immediate shockwave. The research we have calls this explicitly the largest liquidation event of 2025. That's not hype, it's a data point.
It really is. It's just an unbelievable flush out of leveraged positions. We're talking the total value of liquidations across the market, mostly futures contracts. Yeah. It hit a truly staggering figure, somewhere between $1.5 and $1.7 billion, just wiped clean in like a matter of hours.
Wow.
That kind of sudden deletion of capital, it just instantly creates massive, massive price instability.
And the most obvious result of that instability, Bitcoin.
Yeah.
The market backbone. It saw that sharp drop, briefly going under that really key psychological level, $112,000.
Exactly. And once that floor gives way, the selling pressure just snowballs.
But the price drop is only part of it, right? You mentioned the psychology.
Right. The psychology is maybe even more telling. If you look at the fear and greed index, that market sentiment tracker, the change is instant. Stark, really.
Okay.
We were sitting in greed just last month. Even yesterday was neutral at 49. Today, after the crash, bam, it dropped to 45. And that signals fear.
Wait, I want to pause there. Only 4 points. 49 down to 45. Why is that drop seen as so significant? We've seen much bigger daily swings before.
That's a great question. It really speaks to the market structure at that moment. So when you're hovering right around 50 in that neutral zone, it suggests this kind of fragile balance, right?
Okay.
Dropping clearly below 45 into that fear territory, it means that optimism, that feeling of, oh, it'll just bounce back quick, that's gone. It's replaced by real anxiety.
Okay.
It signals to traders that the dynamics have actually shifted. It's not just a pullback anymore. It's a confirmed correction.
Right.
And that encourages more people to de-risk. So that 4-point drop, it sort of confirms the fear has really taken hold.
That makes perfect sense. It's less the number itself and more crossing that line into genuine worry.
Exactly.
So now the big question, why now? What suddenly lined up to trigger this thing, this $1.7 billion wipeout?
Well, the analysis points to about 4 key pressure points, 2 from the big macro picture and 2 more specific to crypto itself.
Oh.
The biggest shadow hanging over everything still is that macro policy uncertainty. We're talking about hawkish Fed policy.
Okay, we hear that a lot, but connect the dots for us. Why did the Fed's tone or lack of change trigger this specific event right now?
Because there's a lot of anticipation or maybe, just hope baked into the market that we'd get clearer signals about an interest rate cut, maybe tied to that September 17th date people were watching.
Right.
When the longer-term policy direction stayed kind of murky, well, institutions got nervous. High-risk assets like crypto, they're always first on the chopping block when holding cash starts looking safer.
And that ties into the second macro factor, doesn't it? The analysis talks about a danger zone because the S&P 500 and the DXY, the US dollar index, were both rising. Why is that combo so toxic for Bitcoin?
Yeah, that's a tricky mix. So the DXY measures the dollar's strength against other world currencies, right?
Right.
When it's rising, the dollar's getting stronger, makes holding U.S. assets or just plain old cash really appealing globally. At the same time, if the S&P 500 the benchmark for traditional stocks is also climbing.
Yeah.
Well, that offers safe, reliable returns. So why would you hold volatile crypto when safer traditional stuff and even the dollar itself are looking strong? Investors just flee risk. Simple as that.
Makes sense. Okay, so macro policy was pushing capital away. What was happening inside the crypto market itself?
That institutional caution became really visible through ETF outflows. The daily flow data showed significant money leaving those newer crypto ETFs. These big institutional players, they're super sensitive to regulatory fog and macro winds. Their decision to pull funds out just amplified the downward pressure like crazy.
And then you add the simplest factor of all, basic human nature, profit-taking.
Exactly. After any kind of run-up, you're going to have natural selling pressure.
Yeah.
I bet there were quite a few people getting nervous around that $115,000 resistance level anyway. And the second they saw those macro indicators flash red, they probably hit the eject button. Combine that urge to lock in gains with the macro fear, the institutional exits, and boom, you get the perfect setup for a cascade of liquidations.
It sounds like a perfect storm, really.
It really was. Brutal.
Okay, but let's look ahead now, short term. Next 24, maybe 48 hours. What's the forecast? Volatility is obviously a given, but are analysts watching specific levels?
Yeah, the market definitely needs some time to consolidate now. Seriously. For Bitcoin, analysts are expecting the price to keep testing those lower support levels.
Like where?
We could easily see it revisit the $107,000 mark and maybe even dip towards $105,500 if the selling pressure keeps up. We're not quite out of the woods yet.
And Ether.
Oh yeah. Keep a close eye on ETH. It's incredibly sensitive right now. The data actually shows ETH led the recent liquidation percentage-wise.
Really?
Yeah, which means it's likely to track Bitcoin's moves very, very closely in the immediate future.
Okay, now for maybe a sliver of silver lining here. Which parts of the market got hit hardest? And did anything show, surprising resilience in all this chaos?
Well, the pain, maybe predictably, is really concentrated in the areas with high leverage and, let's be honest, maybe lower fundamental utility.
Right.
Generalized DeFi tokens took a hit, and certainly the meme coins. Things like DOGE, DOGE, is expected to keep falling as investors look for stability,
Right, but where did the money go? If it fled those areas, what held up? What showed some fundamental value?
The resilience seems to be centered around tokens linked to two key areas, stablecoins and real-world assets, or RWA.
Okay.
These seem to be proving themselves as maybe a safer harbor in the storm.
Real-world assets, RWA. That concept is still maybe newer for some listeners. Briefly, why would RWA tokens hold up better when everything else is tanking?
It's because they sort of abstract away from the purely speculative nature of Bitcoin, or many altcoins, right?
How so?
RWA tokens are backed by or get their value from tangible things, non-speculative income streams, usually. Think real estate revenue, treasury bills, corporate bonds, things like that.
Gotcha.
So when the crypto market itself panics, RWA tokens tend to track the stability of that underlying real asset. Makes them a much more compliant, less volatile option, especially for institutional money.
Okay, this is where it gets really interesting, I think. Shifting focus from the immediate red charts to the longer-term stuff mentioned in the analysis. This crash happened, yes, but those big underlying drivers are still chugging along.
They absolutely are. And number one, overriding the short-term fear has got to be the regulatory shift, specifically the potential passage of the Genius Act.
Right.
This could be a fundamental game changer for how stablecoins operate, not just in the U.S., but globally.
And the numbers associated with this are just huge. The projection is that passing this could boost stablecoin use to something like $4 trillion in cross-border payments volume.
$4 trillion. Yeah.
That's not even just a crypto story anymore. That's global finance.
It absolutely is. $4 trillion suggests stablecoins could really integrate with and maybe even revolutionize traditional global commerce. The Act provides that crucial clarity, the consumer protection framework. That's what unlocks massive corporate and institutional adoption around the world.
And this regulatory confidence seems reflected in the SEC too, right? The analysis points to the new chair, Paul Atkins, being committed to prioritizing a clear framework.
Yes, and that signals a pretty significant philosophical shift, potentially. His focus on clarity. Plus, the analysis notes a bipartisan push from some Democratic senators to get related market structure bills moving quickly. It suggests the U.S. is getting serious about actually defining the rules, not just, enforcing through ambiguity like in the past. That clarity, it's the strongest possible catalyst.
And on the ground, what's the practical impact of that clarity?
It means companies can finally integrate this stuff confidently. It means those cross-border payments, which, let's face it, currently take days, can potentially settle instantly, in minutes, using stablecoin infrastructure. That kind of structural improvement is so massive, it really dwarfs the daily price swings for anyone investing long term.
And it's not just about compliance driving institutional interest, it's also accumulation, right?
Yeah.
The sources highlight this trend of companies adding Bitcoin to their balance sheets just keeps going, even through this volatility.
Yeah, the data is specific and pretty impressive. Look at Metaplanet. They recently bought another, what was it, 5,419 BTC.
Wow.
That purchase makes them the fifth largest public company holding Bitcoin now. This kind of corporate adoption, it creates stable, long-term demand that isn't based on speculation.
Right.
These companies are buying based on a macro hedge strategy, not trying to day trade the dips. That creates a foundation that's incredibly hard to shake, even with shocks like this one.
Okay, let's pivot then to the learner's radar. For you, the listener, trying to synthesize all this, what specific indicators, what events should you be tracking right now to make sense of where the market goes next?
Right. If you're maybe sitting on some cash or just trying to gauge the overall mood, you probably want three key indices kind of open on your screen. First up, BTC dominance. It's currently sitting around 57.7%.
And what are we watching for with BTC dominance, up or down?
Well, typically in times of fear and uncertainty like this, BTC dominance rises.
Okay, why?
Investors tend to pull money out of those riskier, more speculative altcoins, and they flee towards Bitcoin as the relative safe haven within the digital asset space.
Got it.
So if BTCD keeps climbing, say, above 58%, it tells you that institutional caution is probably deepening and that altcoin season everyone's always waiting for, probably delayed. Again.
Makes sense. And second, given the trigger, we have to track ETF flows.
Religiously, right?
Yeah.
Oh, absolutely. We saw those huge outflows leading into the crash. So watching the daily data now is crucial. Are institutions starting to buy the dip? Do they see current prices as a good entry? Or are they still pulling funds out?
Right.
A return to consistent positive net flows into the ETFs would be a really important early signal that broader market confidence is starting to recover.
And finally, based on what caused this whole mess, what's the needed update to risk strategy?
Well, this liquidation event is probably the loudest reminder you could possibly get. Be extremely cautious with high leverage right now.
Yeah.
The recommended strategy coming out of this analysis is really about diversification, looking at those long-term potential areas that offer a different risk profile, specifically the stuff gaining regulatory traction like RWA and stablecoin infrastructure. Don't chase those short-term, highly leveraged plays when the macro picture is this choppy.
Okay, beyond the daily indices, there are specific dates or events to watch, especially around September 23rd, 2025.
Correct. The market's going to be hypersensitive to any official commentary. So any scheduled Fed speeches where officials talk about the economy, inflation, interest rates, that's guaranteed to cause market swings.
What are we listening for?
The tone, is it still definitively hawkish, signaling more tightening ahead? Or are they starting to sound maybe a little dovish, hinting at potential easing down the road? That tone shift matters immensely.
And then there's the potential upside surprise tied back to that big long-term catalyst.
Exactly. Keep your radar tuned for any unexpected news, any progress or key discussions about the Genius Act moving through the Senate.
Because the potential impact is just so huge.
Right. That $4 trillion projection we talked about. Any positive news on that front could instantly inject a massive wave of confidence, especially benefiting stablecoin projects and maybe DeFi tokens that are built on regulated assets. So if we try to synthesize all this data, the market right now is really battling itself, isn't it? You've got the immediate, visceral emotion of extreme fear that $1.7 billion liquidation is proof of that. But bubbling underneath that fear, you have genuine, powerful, long-term structural improvements. Things like regulatory clarity and that steady corporate adoption.
That really is the core tension, isn't it? The liquidity crunch plus the Fed uncertainty means we're probably entering a consolidation phase.
Seems likely.
Expect Bitcoin to probably trade sideways, consolidate somewhere in that $107,000 to $115,000 range for the next few days. Assuming, of course, no major unexpected news hits.
Right. Which brings us to our final thought for you, the listener. We mentioned the fear and greed index is at 45, signaling fear. Now, remember that contrarian principle the analysts often cite. Extreme fear can sometimes be a buying opportunity. So if that index keeps dropping, maybe it hits 30 or 25. Extreme fear. What specific level of fear would be enough for you to genuinely start thinking the market might be fundamentally oversold? When does that structural improvement story we discussed finally start to outweigh the immediate panic?
That's your challenge for the week. Think about that level. We'll be back soon with more analysis. Until then, Stay informed and stay curious.